video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy Camel and this is the weekend's deep dive. On the weekend, I like to come back and check in on the base case hypothesis. If you want to continue to follow along with these, please do hit that subscribe button and check in on this base case hypothesis of mine every weekend with the rest of the Camel Crew. So far, if I do say so myself, this has been a fantastic set of expectations. It has, largely speaking, played out very, very nicely. And as always, I will be the first person to hold my hands up and point at one or two things if they start to go wrong. So without further ado, the thesis for the stock market was that the lows we were too bearish and we would have a blow off top to all-time highs. We would see rate cuts around the top and then enter a global recession, a bear market. And the key part of this is I was expecting a deflationary component. Something else that is quite interesting about this is if we are indeed going to have a blow off top, the high that we put in may well remain the high as we experience another one of these lost decades whilst the indicator, the stochastic at the bottom, resets itself. And as Andrew points out, we have a 17-year top-to-top cycle that is observable in the S&P 500. These are 12-month candles, and it tells us, on a balance of probabilities, what we will see is next year's candle actually be a red 12-month candle. Fast forward to today, and I believe we are in the third and final blow-off top angle for this stock market. I have put a red arrow here, and it's not me trying to call tops, but it's me saying if we top there, that will actually make a great deal of sense to me. So, as always, if we continue past my red arrow and we're still holding this third and final angle, I will stay long and strong. I will show you the live trades and positions at the end, as always. But something tells me we are going to get up into this 9th of December time frame and then break this third and final angle, and that is going to be all she wrote. So, we are at a wild, wild time now. I'm getting dangerously close to thinking this thing is not making it out of 2024 without seeing a bear market and recession as of next year. And of course that would all be quite obvious in hindsight, and again would fit with the base case hypothesis. So far I would say the stock market, happy days there. Bitcoin was one component, and arguably we're going to get to inflation in a bit. Arguably inflation is throwing a little bit of a curveball as well. But up until last week's inflation print, Bitcoin was the only component for me that hadn't quite played ball as expected. We've been expecting a blow off top and an all-time high before the halving, and ultimately a top much earlier in the 4-year cycle than we've ever seen before. I was long suspecting it would left translate, meaning we would top before November of this year. Two things of this didn't quite go as expected for me. Number one, we spent way longer in here than I was anticipating, and number two, I was also thinking the top might come before November of this year, when in fact, clearly, we are about to be December. So this is no longer going to qualify as a left translated cycle. Happy days, because the longer this thing goes on for, the higher the top will be and the easier it becomes to sell the top. Given that we did spend more time than I was anticipating trading in this range in here, I then had to, of course, shift my stance. It's no good being dogmatic and sticking on a stance if it's clearly invalidated. So I shifted. Not sure why we're not paying Tony the Bull credit here. This is Tony's chart. As I was saying, I shifted my approach so that rather than expecting cycle low and go or cycle low and go, we have now been expecting it from slightly later in life. I've been consistent in saying if this Elliott wave count is correct and if we really are going to have this big blow off top fifth, then what we would need to see is Bitcoin's price immediately start to go vertical. I would say anything other than that, more consolidation sideways, any kind of lackluster grinding and performance or breaking down of this channel, and we would have to invalidate this setup. As you can see down here, if this is indeed what is in play, we should be going near vertical right now. And of course, as of yesterday, we were targeting 100k Bitcoin with a chart looking something like this. So not too bad. Hard for me to say anything other than the expectations are occurring at this current moment in time. Looks a lot to me like we're going to continue to do something like this, overthrow the channel, and then I think we're going to be in that neighborhood where we have to entertain an extended bear market decline. If somehow we can stay long and strong for much longer than I'm anticipating, then again, I am more than happy to do that. I am more than happy to be the camel on the internet that has been premature in calling tops the entire way up, but remained long and strong. Okay, it's never really about guessing the month for me. It's just about extracting as much money out of the move as I can. So all the while we're trending up, I remain long and strong. But as I've been saying over and over again, I do think that we are going to see a top come in much sooner than most people are anticipating. As ever, open to being proven wrong. As Ben shows here, the price action in Bitcoin is currently mimicking the Dow Jones Roaring 20s fractal to the dot. I believe this chart was from Credible Crypto about 4 months ago. And you can see here the Wall Street Roaring 20s bubble underwent a hyperwave and was countable in 5 waves with that extended blow off top fifth. And what have we got for Bitcoin? 1, 2, 3, 4, looking for a blow off top fifth. As I said, this chart is 4 months old, so we've obviously spent a little bit more time in here, but I now believe we are indeed working on that final fifth wave, and it probably could look something like this. So Wild, wild, wild times for sure. As ever, we'll keep taking it one day at a time and we'll keep being open to all possible outcomes. Stock market, wholly speaking, going according to plan. Bitcoin seems to be blowing off. Happy days there. Wholly speaking, everything is still going according to plan. Now, if I am right about the next part, then we are going to get a bear market, a recession, and this is going to be a deflationary component. For a long, long time, we've been using this chart, and I've been making the case anything you do here to the M2 rate of change shows up in the CPI with a lag. We did very, very well to use this metric as a leading indicator to predict what would happen to CPI. CPI did indeed move down sideways for a while and then down. That was until last week, when of course we got a 2.6 headline CPI print for inflation. We've also done quite a good job on this channel of using Trueflation to predict the overall direction and trend. And this was one of two times since I've been doing this for over 2 years now that we have seen such strong divergence between the US government reported rate and the Trueflation readout that corresponded to this neighborhood here. Although, as I've shown before, I still maintain that the government reported rate is not actually representative of what is happening in real time in the economy. Now, by all means, if you think this is me fitting a bias to a narrative or narrative to a bias, if you think this is confirmation bias or whatever, you're entitled to think that way. I'm by no means trying to convince you. But when we do dive into the data here, I'm not going to run through all of these because we've done it before. But the cliff notes are, okay, headline CPI is trading in the same neighborhood today that it was pre-C19 era, pre all that huge printing, stimulus, quantitative easing, and therefore inflation. And whilst the 2.6% may seem sticky, 2.6% is actually incredibly close to the Fed's target, and that is because they are not targeting 2% CPI, they are targeting 2% PCE, which corresponds with a headline CPI of 2.5%. So the 2.6%, even if you take this at face value, which I do not believe is true, should correspond to almost 2% PCE, and thus the inflation is already at the Fed's target. Core CPI remains in a downtrend month over month, okay, so again, I still maintain that deflation is the risk, not resumption of inflation. And the last thing I wanted to point out here is, whilst that number in shelter is still around 4.9% year over year, if we use more of a real-time and representative metric, such as the ALNRI, this is currently number one, deflationary year over year, and number two, it has been for roughly 1.5 years. So I continue to make the case that the Fed is using lagging metrics, lagging indicators to try to tame inflation. Meanwhile, in the real world, the real risk here remains deflation. Again, I'm not trying to convince you of anything. If you want to sit there and say inflation is sticky, bro, it's going back up, 1970s fractal, that is entirely your prerogative. But for me, I maintain that we are going to continue to see inflation come down, and all of that is going to make a lot of sense in hindsight. The next portion of this, of course, if we're going to get a bear market and a global recession, we need to see labour market deterioration. I still continue to see a similar theme when I look around. People keep looking for excuses. They're looking for ways to explain away the data. And one of this was, well, the hurricane impacted employment numbers. But non-temporary unemployment has actually hit 2.554 million, which is the highest in 3 years, up 48% from its recent low. And this metric is less affected by weather-related distortions. So this, again, does not look healthy. This is a real-time metric that is showing us labour market deterioration right before our eyes. And this is against a backdrop of many, many, many market participants trying to say things like, no way we're getting a recession. Meanwhile, the Fed doesn't seem to agree. The Fed continues to quietly revise down the jobs data by close to 500,000, as you can see at the bottom of the screen. And as if that's not bad enough, it gets a lot worse, because we just had QECW come out for Q2 23 and Q2 2024, and that is suggesting that the BLS is overestimating by 100k a month still. This suggests it's only a matter of time before the Fed is going to be forced to start panic cutting, okay? This is recessionary, and again I note, whilst I sit here and show all of this data time in and time out every weekend, we check in on it and it continues to happen right before our eyes, we've also reached a point in the market where people don't want to have this conversation anymore. For some reason, they want to sit here and say, yeah, well, none of this means anything all of a sudden. Going back, historically, this kind of thing was alarming, but right now, apparently, it just doesn't mean anything. Nobody cares for some reason. So pretty wild times as far as I can tell. All of this makes a lot of sense, and again, we continue to check in on this kind of data once a week, and it doesn't really show any signs of letting up. No changes to the SAM recession rule, but by the 1st of December, we should get a new read on the SAM recession indicator, and it's going to be really interesting to see if this trend at the bottom of higher highs and higher lows continues, signaling a recession is indeed coming, or if by some miracle what we can see from here is a turn down and a rollover, which would lighten up the idea of a recession, at least pertaining to this one metric in the short to medium term. I've got some new data for you in terms of the consumer, okay, because I've been showing this, that the auto loan delinquencies are starting to skyrocket and they're getting to the levels that we last saw at the GFC, and this is on a record amount of debt, which is in red here. I've also been showing things like credit card debt continues to rise and the consumer continues to be in worse and worse shape, but take a look at this, because once again, it's getting worse right before our eyes and nobody wants to have the conversation, likely because the stock market keeps going up and everyone's making money hand over fist. But just because the stock market is going up and the times are easy, we've all got plenty of cash right now, does not necessarily mean that this is sustainable forever. And we can see that in the consumer, okay, because this is rejection rate increases, credit cards spiking, mortgages spiking, auto spiking. Okay, the consumer is in bad shape. The consumer is stretched. The consumer does not have a bunch of money to go out and stimulate the economy, and this is exactly what drives the recessions. The bond market also seems to know this, okay? We were using the 2-year yield to accurately predict the onset of the cutting cycle. At the time, I was saying, look, we could probably squeeze a bit higher, but then it should be time to start to roll over because we are indeed cutting into a slowdown rather than normalization, just like the prior 3 instances. What we have now is the illusion of a soft landing, but based on all of the data I've shown you, that is not going to last much longer. And again, I sit here and tell you to tell that to the bond market if you disagree with me. Why? Because this is the 10-2 yield curve. What you will notice is it inverts, reverts, and then accelerates. And that acceleration back above the 0 line after the reversion is synonymous with seeing risk off and recessions, okay? We saw the same thing here. Inverts, people get it wrong, they call recession. It reverts and accelerates, and once it starts to accelerate, that's when we get the onset of the recession. Same deal here. It barely inverted, reverted, but it's the acceleration, okay, that leads and coincides to stock market plunges. And what we have here at the moment is not only a record inversion, but for a record length of time. Not only have we got that, it is also reverting back above, and the only thing that is missing now is the acceleration. Once that acceleration starts, we will probably see this coming down. We'll see tops come in for the stock market. And once again, I point to this and say all of this is occurring against a backdrop of people saying we are in the early stages of a bull market. We are early in a melt-up. I do not believe it. Once more, we stay long and strong until the market breaks down. I'm not just selling because we've got some charts that look recessionary, okay? We continue to ride this trend until the trend breaks, but I think this thing is going to break pretty soon, and I think it's going to catch a lot of people off guard, especially because they're going to be buying the dips on the way down, saying things like we are early in a bull market. Something that's even more concerning to me, and should be to you, is whilst this is the 10-2 yield curve, okay, this one is a little bit laggy relative to the 10-year 3-month, which I consider to be the signal. Now, when I showed this before, I was saying it's not quite inverted, but once it does, alarm bells should be ringing. You can see once this thing reverts, the stock market top is very, very close. Once this thing reverts, the stock market top is practically already in. Once this thing reverts, this thing had already topped. And you can see we are within spitting distance as of a couple of weeks ago, but when we update this chart to today, we are even closer, okay? In this chart back here, you can see we were minus 0.264, and today we are just minus 0.134% away. Okay, so we are edging closer and closer to this, and historically speaking, that reversion back above the 0 line followed by acceleration leads to imminent tops in the stock market. So if you're sitting there saying anything akin to we're in the early stages of a bull market, no way you're getting a recession, all of this kind of thing, once again I sit here and say tell that to the bond market. Absolutely wild times to be alive. And I want to just point this out one final time. If we do get some kind of squeeze into the end of the year and then it breaks down and breaks down and breaks down, will this be obvious in hindsight? Will we be able to look at this and say, no way we could have seen that coming? Or will we be able to look at all of this data and some and say, you know what, this whole thing kind of made sense. Having a stock market go completely parabolic was clearly not sustainable. And parabolic advances in the markets tend to violate spectacularly to the downside. So once again, I sit here and suggest to you that the Fed is wrong with its rate cuts. We've done this plenty of times before, and we usually turn out to be correct. This, I believe, is going to have to reprice in favor of seeing more cuts because the bond market is imploding right before our eyes. All of this is occurring on credit spreads continuing to tighten. Okay, now the tighter this goes, the more violent the explosion is going to be. And if you don't know what that implies, it implies we get financially stressed conditions and recessions. We also saw the exact same thing during the 2008 bubble. So I continue to trade in and out of this thing the whole way up in front of everyone. I continue to call these positions out ahead of time, and I continue to be long and strong and bearish all at the same time. It's a very weird posture. I don't really see anyone else out there that is long, strong and bearish. Okay, most people have either been bearish and doom posting and recession callers and missed the move or doubted it the whole way or called it bull traps the entire way up, or they've been super duper uber bullish the entire way up and they see no sign of this thing ever stopping. trading. So I seem like I'm one of the very few people out there that is long and strong and bearish all at the same time. But the most recent positions added after we went flat before the yen carry trade unwind occurred are continuing to be pushed, will continue to be pushed. And as ever, I am open if we get to this red arrow of mine and we don't see a top. If we keep blasting higher, if we keep holding support and we keep firing off, then I'll stay long and strong until the market breaks down, right? But so far, I think we are getting into that neighborhood where we're going to see this all start to occur. I know a lot of people say, well, how can you expect Bitcoin to run in the face of the stock market melting down or whatever? And the answer to that is quite simple. If this yellow squiggle of mine is right, all of here will be like a distribution type top. And that gives us a few months for Bitcoin to complete its blow off top. We're already here, okay? So that would probably look something like this into, I don't know, February-ish time frame. And then that may well be all she wrote. 4-year cycle low in 2026 becomes the next major opportunity. So again, weird posture to take, long, strong and bearish, but that's how it is at the moment. Same deal with the Nasdaq. Okay, we went flat before the yen carry trade unwind, got back in once momentum had returned, and I'm still kind of expecting to see a top this year. We'll find out if I'm right or wrong about that. The Dow Jones once more continuing to move higher, happy days there, and the Russell 2K, that position from the lows continues to be pushed and will do until we violate this upward sloping support line. At that point, you will see me exit this market and nail down the profit. Or if we get up to above about 2,800, I will probably start to take some off here as well, because I think this is going to be completing somewhere between 27 and 3,000. Gold is expected to top around Monday or Tuesday. If it doesn't, and it continues to kind of trade up here, then we might have to entertain this being an early weekly cycle low. Now, I don't like it. It doesn't look right on the weekly chart. It would be very, very rare to see a setup like that. So on a balance of probabilities, I do think we roll over. But if we continue to move higher, then we may have to hop on this trend. And of course, make sure you're subscribed if you want to see me do that in real time. Silver, I think, is the tell though. Silver is not believing what gold's price action is showing us. Silver still kind of thinks that we need to follow my yellow squiggle down into a weekly cycle low. So I don't quite think I believe gold just yet, but we'll find out. And the miners, I'm also noticing, aren't really believing gold either. So happy days, right? For now, if we're going to see a top for gold on a left translation in the daily cycle and that failure into the weekly cycle, which is expected, then we should see that this week coming. Other than that, Bitcoin refusing to hit 100K. Okay, so no one wants to be the first guy to buy 100K apparently, but wholly speaking, this thing has been moving very much in accordance with expectations. We're still pushing along from the prior cycle lows. We've sat through a whole cycle. We've got the next cycle low due around January the 4th or the 5th. And there'll probably be a half cycle low shakeout in the first week of December too. I have been very consistent in saying I think I know what happens here. Something akin to this, a daily cycle low and then a huge blast off. Once more, that would probably look, we're already here, probably look something like this, cycle low and go. So no real changes to the plan. I think it may well be time to see these yields roll over once more, something akin to this, right? That would make a lot of sense to me. And the other thing I wanted to point out is, because a lot of people say, no way you're getting deflation, right? Well, once more, have a look at the dollar, okay? A lot of people, and I said this many times before, when I first put this yellow squiggle on the table, thought this was absolutely bananas. Nobody thought this was possible, but we're already outpacing this. And is this a right translated daily cycle? Because it looks like it. Let me zoom in. Okay, day 13. So very, very good chance that this is right translated now. And if that's right translated, what does that imply? It implies that all the people calling for a lower Dixie, for it to lose this 100 level, all of the people that are saying it's going to go to 95 or 80 or whatever the number is, are actually wrong. Okay, and what instead we're going to get, as I've been warning for weeks now, is a right translated daily cycle and then a huge risk off moment. For this to occur, okay, a lot of people get this wrong. They say things like, well, Camel, with the bread in the supermarket's not getting cheaper, so deflation can't be correct, right? The reality is this deflationary crash, this huge bid in the Dixie, if it's going to occur, will be driven by a stock market implosion. It will be driven by, like I keep saying, a top coming in, a third angle violation, and then a huge risk-off moment. That risk-off moment causes investors to flee risk and hide in the Dixie, putting a huge bid in the dollar. Okay, a huge bid in here, and that's how you get this big risk-off deflationary bear market type deal. So no one wants this thing to roll over more than me, believe me. Nobody wants to see this more than me. Nobody wants to be able to grab this yellow squiggle of mine and put it down here and say, okay, we've got plenty of fuel to add to the melt up. We've got plenty of fuel to drive Bitcoin to 300K and all of that good stuff, right? Nobody wants this more than me. But based on the cycles do not support this. The price action currently does not support this. And also, just quickly eyeballing this thing, does this not look suspiciously, let me get my pen, like a huge Wyckoff accumulation, sign of strength, and then phase E? That's what it looks like to me. Again, hope I'm wrong. Hope we've got many, many months of bull market left ahead of us. Hope I can stay long and strong and keep buying every dip in this uptrend all the way until the end of next year. But so far, all I see is more and more newer people coming into the space, more and more people 100% sure they've got the code cracked, more and more people saying things like it's early in the melt up. When Bitcoin is already approaching 100k, well above 400 or 500% returns, the S&P has had one of its best election year performance in 88 years and is up 70% since the October lows. So I'm not sure exactly how you define early, but for me, alarm bells continue to ring. I'm not trying to be a doom poster. Again, I remain long and strong publicly with my public invalidation levels. You can see them at red here on the right-hand side. Okay, this is the stop loss levels for all trades. Level 3 members continue to be notified in real time. But I just don't see how we continue to do this indefinitely. Also, I think with the things like the dollar, as I was saying, and these yield curves reverting, the writing is on the wall for those of us that choose to pay attention to it. I'm your boy Camel. I hope you found value here today. I hope you have a fantastic weekend. If you're a level 3 member, look out for the video I'm about to do for you guys. Other than that, take care. All the best. Cheers. Bye.
Camel Finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his money game. He's a badass, oh yes indeed. Camel Finance got the markets key, taking us normies on a bumpy ride.